Did you know that the total value of the entire US stock market is $49 trillion, which is almost 200% of the entire US GDP? That's crazy. Let's go. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe, and I really hope you're ready to invest into some stocks of our neighbor, United States of America. We will be focusing on solid monthly paid dividend stocks on the US stock market, which have consistent dividend payouts, increase their dividends on a regular basis, and also have a pretty good share price appreciation over a long-term period. And you would ask why I'm looking at US stock market. We have plenty of stocks on TSX, plenty of dividend stocks on TSX, and I talked about that before. There are a lot of great dividend stocks on TSX that you can invest into. But historically, S&P 500 index with US stocks perform better than its counterpart on a Canadian stock exchange. And when I say perform better, it means 4 times better. So it's definitely worth taking a look at the US stock market and see what else you can find there to improve your portfolio. So it's important to look at the US stock market as well and see what's happening there, and probably invest in a couple of US stocks or US ETFs so that our FOMO is not really big, fear of missing out. And where I'm getting with this is that even with all the potential taxes implications that you might need to look at when you're investing into US stocks or ETFs, where you're getting paid dividends from US companies and all that, the performance and the returns you're going to be getting back, if you invest correctly of course, will cover all of that. Again, just my thoughts, it's not an investment advice. I personally invest into US dividend stocks and US dividend ETFs. And there are 3 ways how you can use your brokerage account to hold US stocks. And the best account actually for you to hold your US dividend stocks is going to be your RRSP account. Why? Because RRSP is actually sheltered from all the withholding taxes for US dividends. So it means that you're not going to be paying withholding tax for all the dividends you're getting from US stocks if you hold them on your RRSP account. And the next best account for you, if you don't have enough room on your RRSP account, is going to be your unregistered or margin account, where you're going to be paying this 15% withholding tax for US dividends, but you can recover all or part of that with a foreign tax credit. And the last option is going to be your TFSA account, where you're going to be paying this 15% withholding tax, but there's no way to recover that. So this is the worst choice. I would suggest you going with number 1 or number 2 if you don't have room on your RRSP account. So now you know where to hold your US dividend stocks. We covered that. Now let's jump and see what are the best monthly dividend stocks out there that you can invest to and get this reliable passive income every single month. And the first one is Gladstone Capital. The ticker symbol is GLAD. This one is traded on NASDAQ. Gladstone Capital provides capital to mid-sized businesses in forms of loans. The business model of this company is actually well suited to support dividend payments. These middle market companies who use Gladstone loans are pretty risky, but they're not necessarily doomed. These companies are willing to take loans at above average rate that reflect their relative risk. And Gladstone is actually pretty happy to give out these loans for these high potential companies. And like any other loans, these loans are paid out gradually on a long-term basis. And a portion of these payments are actually paid out to shareholders in terms of dividends. So that's how their business works, and that's how we get our dividends from them. And to prove all of that, Gladstone actually hasn't failed to make dividend payment in any single month since 2003. And that was the year when they started giving these dividends on a monthly basis. So that's pretty cool. You can see this super long-term, consistent monthly dividend payouts without any interruptions. So we can see this company can sustain these dividend payouts. The business they operate in works really well, and that's why we can also rely on these dividend payouts. And now let's sum all that up into our metrics. The market cap for this company as of today is around $386 million. So as you can see, this company is not huge, but they actually performed really well over the long-term period. Their current dividend yield is around 7.2%, which is pretty good we're getting a lot of dividends back, and their 5-year average dividend yield is actually at 9.5%. So historically, the yield was actually even better than it is right now. But what it tells us is that the share price probably right now a little overpriced. But on the other side, the company's been growing pretty fast over the last couple of years, and this growth actually can be sustained in future. And I think they're gonna start increasing their dividends going forward. Their dividend increase has been consistent over the last couple of years, but they haven't skipped paying these dividends for the last 18 years. Their payout ratio is actually a pretty sustainable number as well, is at 40%. And what it means is that they're getting enough cash from their earnings they can reinvest back into their business in order to grow, in order to get more companies with these loans, which means they're going to be paying even more dividends going forward. In terms of the share price appreciation over long term, over the last 10 years, the price grew by 23%, which is not a lot, but it's a pretty good number if you look at it over a long-term period, and also as this is a dividend-paying company, not necessarily a growth stock. What also good about this company is that the DRIP amount is actually pretty affordable. It's at $2,100. What it means is that if you invest only $2,100 into this stock, you'll be able to get enough dividends back every single month that you can reinvest automatically back into this stock in order to get a single share, which will allow you to get 12 shares per year. And this is the way how you automate your reinvestments and how you can get this compound growth over a long-term period. And this is especially good for US stocks, so you don't have to do any extra operations when you want to reinvest back into these companies. Their beta parameter is at 1.46, so it's a little volatile stock in terms of the share price over the short-term period, but looking at it over a long-term period, we shouldn't worry about that. Gladstone, in my opinion, is a very solid monthly dividend stock that hasn't failed their investors for the last 18 years. It is hard to find this consistency among dividend stocks, and I have it in my portfolio for a little while, and I keep reinvesting back all the dividends I'm getting from them. Let's move on to the next one now, which is the Real Estate Investment Trust, Realty Income, and the ticker symbol is O. And this one is traded on the New York Stock Exchange. Real estate is actually a pretty hard business. We've seen the worst happening to them over the last 20 years, and last year was not an exception, where a lot of real estate companies just dropped all the way down. And the reason for that was the lockdowns and all the companies were shutting down, so they stopped using their facilities and all that. But Realty Income is actually very different from all of that. And why is that? Because Realty Income is actually very big and very diverse. And that is why diversification is a pretty big thing, not only for investors and what stocks you're adding to your portfolio and what sectors you add into your portfolio, but also for the stocks themselves, how they diversify their businesses, how they invest into companies from different sectors, how they choose to diversify, for example, their real estate business. And that is exactly what Realty Income is doing. They have more than 6,500 properties that hold long-term leases, and they were able to collect around 93% of their rent as of last quarter of last year. And all of that is mostly because the way the company diversified their real estate. For example, their 5 biggest renters are Walgreens, 7-Eleven, Dollar General, FedEx, and Dollar Tree. And Walmart and Kroger are also their major tenants. And these are the companies that not only survived the pandemic of last year, but they actually benefited from it. And that's why the Realty Income is also could sustain their dividend payouts and could sustain this stable cash flow over the last year. The company's shares are up 42% over the last year and around 5% since the beginning of 2021. And they also just recently raised their dividends again, and they've been doing that consistently for the last 27 years. So this company is the big dividend player. They've been paying their dividends without interruptions for a long-term period, and they also been increasing their dividends consistently for the last almost 30 years. That's pretty crazy, and that's very good for us dividend investors. And as we all like to look back, what would have happened if we did something? For example, with Realty Income, if you invested in this company when it first appeared on the New York Stock Exchange in 1994, you would have an average compound annual return of 15.3%. This actually compares very nicely to S&P 500 index with an average return of 10.3%, or Nasdaq Composite Index, which had a return of 11.4% annually. So as you can see, even with all the market crashes over the last 30 years, and that this company is actually in real estate business, they still have a pretty good returns on average, which are actually better than S&P 500 or Nasdaq Composite Index. Let's sum all of it up into our metrics. Their market cap is around $25.6 billion, so it's a pretty decent sized company, which is good, and it's very good for long-term investors. Their current dividend yield is at 4.1%, and their 5-year average dividend yield is actually at 4.2%. So it's pretty much the same. The company keep increasing their dividends year over year, and the share price is also appreciating year over year. And as I said, they've been increasing their dividends consistently for the last 27 years. They pay out dividends on a monthly basis. And there's also one more important metric here, is that their FFO, funds from operation, increased consistently for the last 12 years. For example, last year it was $3.39, and if you compare it to 2019, where it was $3.32. And that is an important metric to look at for real estate dividend payers, so you can see that the dividends can be sustained over the long-term period or not. Looking at the share price appreciation over the last 10 years, the share price grew by 104%, which is pretty good considering this is actually a dividend paying company. And now you can also see that you can gain from the share price appreciation as well. Their DRIP amount is actually on the higher end. You would need to invest $20,200, yeah, that's the number, into the stock in order for you to get enough dividends back that you can reinvest on a monthly basis automatically. So don't worry about that. You can invest whatever amount you want, and then eventually you can get to the number where you can set up your DRIP and automate your reinvestments. And their beta parameter is 0.73, so this stock is not very volatile over the short-term period, but this stock is also considered a very good investment for long term. So don't worry about the risks over the short-term period. And in my opinion, Realty Income is actually one of the best real estate investment trusts out there across North America, actually, where you can see that their portfolio is pretty big, is actually very well diversified, and you can rely on dividend increases for a long-term period, and you can get this consistent dividend payouts on a monthly basis. And this is the company that can sustain their dividend payouts even going through the worst economic conditions. And the next one is going to be Stag Industrials, and the ticker symbol is STAG. And they're traded on the New York Stock Exchange as well. And similarly to Realty Income, Stag is also organized as real estate investment trust. However, Stag is actually aimed at a completely different type of tenants for their portfolio. This real estate investment trust offers single tenant industrial and commercial space to a wide array of renters. No one tenant accounts for more than 4% of its rents, and no more than 8% of its annual base rent comes from any one business sector. Stag Industrial also touts that about 40% of its renters are involved in e-commerce, somewhat shielding them from the impact of the pandemic-like market crashes. In the fourth quarter of last year, Stag actually reported that their occupancy rate is at 97%, and that they had collected around 99.6% of their rent. Their funds from operations increased by 22% year over year. That shows that the dividends payouts is actually pretty sustainable, and they can increase their dividends going forward as well. And also over the last 5 years, Stag actually reported that their returns increased by 121% and their funds from operation increased by 99.7%. So we see this consistent growth over the long-term period, which is 5 years so far, and I believe we can see this going forward as well. Let's take a look what we have for them in our metrics. Their market cap right now is around $5.7 billion. So it's a decent sized company. It's not necessarily a huge company, but they've been growing gradually over the last 5 years. Their current dividend yield is at 4%, and their 5-year average dividend yield is actually at 5.2%, which tells us that the share price is probably a little overpriced, but also looking at what company is doing, where they're going, how they're growing and improving over time, I think they are lined up for a pretty good dividend increases over the next 5 to 10 years. Right now, their dividend growth strike is at 7 years, which is pretty good for a company like this. And yes, they're paying dividends on a monthly basis. And again, looking at their share price appreciation over the last 5 years is at 121%, and over the last 10 years is actually at 190%. So we see this long-term share price appreciation and also a pretty consistent dividend payout and a very good dividend increases over the last 7 years. Their DRIP amount is also at a higher end, similar to Realty Income. It's at $10,800. So if you invest this amount into this company, you would be able to get enough dividends back every single month that you can reinvest back into this company in order to purchase a single share back. Their beta parameter is 0.89, so in terms of the share price volatility over the short-term or long-term period, there is nothing to worry about. And as you can see, these are the companies that are lined up very nicely for a long-term investment portfolio, and they can sustain their dividend payouts, they can sustain their dividend increase over time as well. And in my opinion, the best thing to do here is that have these companies on your RRSP account, reinvest all the dividends back to these stocks as well, so you can gain from the compound growth over the long-term period. And by the time you start using your investments, your portfolio is going to be large enough that you shouldn't be worried about anything else and just go on a trip to Florida and spend the rest of your life there. Isn't that nice? And with all that, thank you for watching. Drop a comment below if you're investing into any of these companies or any other US stocks or ETFs. Happy to hear, happy to chat. And don't forget to smash that like button, subscribe to my channel, hit the bell, and I'll see you around. Stay safe out there. Cheers, bye.